It's another business day. Welcome to Business Morning. Good morning. I'm Ini John Mekwa.
And I'm Ladi Williams. Good morning. Great to have you. The federal government has been explaining reasons behind Nigeria's low ratings on the Transparency International Corruption Perception Index, blaming it on gaps and opaqueness in doing business in the country. Minister of Information and Culture, Lai Mohammed, explains that reforms have been initiated, particularly in the port sector, to engender more transparency in the system. He says inconsistencies in the Transparency International ratings in the last 10 years is likely owing to inadequate data. He made the comments after the Federal Executive Council meeting chaired by the President. To take a listen.
We take this rating seriously, so we actually went and analyzed the ratings, and we found that there's been some gaps. Either we have not forwarded enough data, or they have not, analyzed such data. Because we found it strange that the country's rating in certain areas remained the same for a period of 10 years, and we are making, we are taking remedial measures so that they can get this data in respect of these sectors, because we believe that it's not possible for you not to improve, for you not to lose points for 10 years. So there's a bit of discrepancy there. And you see that in recent time we've embarked on various reforms at the sea, at our seaports, so that our rating will improve. So that is why we're concentrating on the ease of doing business, making sure that people can get to the ports, clear the goods in good times. And by the time some of these reforms are put in, start yielding, fruit, I'm sure that the perception will.
Well, Ladi, the minister talked about the reforms in the ports, and we know a lot of the call-up app going on in Lagos Port. So let's hope that this would improve.
Too,
Yeah, of course, it should improve the ease of doing business. Yeah. And we do hope that the country will have a better perception when it comes to fighting corruption.
At the end of the day, we need to try and change this perception.
Yeah.
Just do things better.
Exactly, because it also attracts or sends away investors, foreign investors.
We need to send the right message at this time.
That's right.
Yeah.
Well, in the meantime, the federal government's decision to commit $1.5 billion to rehabilitate the Port Harcourt Refinery is still generating reaction from various quarters, the latest being the House of Representatives. The lawmakers mandated its Committee on Petroleum Resources Downstream to organize an investigate hearing to ascertain the true state of the refinery, as well as carry out a comprehensive audit of funds previously spent on the Port Harcourt Refinery and other refineries across the country. The House is worried that so much has been spent on maintaining and rehabilitating the refineries, but the output has barely improved. The motion was moved as a matter of public importance by Representative Onofiok Luke at the House yesterday.
Previous rehabilitations notwithstanding, the Nigerian National Petroleum Corporation NNPC audit report had last year reviewed that 3 of the nation's 4 refineries recorded 1.64 trillion naira cumulative losses in their 2014 to 2018 details. Despite processing no crude oil in June last year, the 3 refineries still cost the country 10.23 billion naira in expenses. The 3 refineries processed no crude oil because of the rehabilitation works being carried out on them. Therefore, there was no associated crude plus freight cost for the 3 refineries since there was no production, but operational expenses that amounted to 10.27 billion naira. This resulted in an operating deficit of 10.2 billion naira by the refineries, Mr. Speaker. The House therefore resolves, 1, to mandate the House Committee on Petroleum Resources Downstream to carry out an investigative hearing and conduct a comprehensive audit of funds previously spent on the rehabilitations to repairs and maintenance of the Port Harcourt refineries and the key performance indicators therefrom.
All right, let's look at the global oil market. Oil prices skidded around 2% as fuel demand concerns re-emerged alongside fresh coronavirus pandemic lockdowns, trimming overnight gains spurred by the grounding of a giant container ship blocking crude shipments through the Suez Canal. Brent crude futures slid $1.14 to $63.27 a barrel after jumping 6% overnight. U.S. West Texas Intermediate crude futures dropped $1.27 to $59.91 a barrel after climbing 5.9% overnight. Prices had tumbled early in the week on worries about tighter pandemic curbs in Europe and vaccine delays stalling growth in demand for fuel, but sharply reversed on Wednesday with the grounded ship in the Suez Canal potentially blocking 10 tankers carrying 13 million barrels of oil. Given the persistent demand worries and falling prices, expectations are growing that the Organization of Petroleum Exporting Countries and Allies will roll over their current supply curbs into May at a meeting scheduled for April 1st. Well, we'll look at the trend in the global oil market and other economic developments here in Nigeria with Akintoye Uyelako, investment analyst at Quadros Asset Management, next. Do stay with us.
Daily news reports from different parts of the country. On News Across Nigeria, we highlight issues in your communities and keep tabs on the government promises of better healthcare, education, infrastructure, security, and other dividends of democracy. Watch News Across Nigeria live at 3 p.m. every day.
Stay connected to the world with Channels TV Podcast and get all the trending stories. Simply log on to channelstv.com, click on podcast, select the program of your choice, and listen. Our podcast is available on Apple, Google, and Spotify. Tap the expertise you trust. Touch the stories that touch you. Anytime, anywhere.
Well, we have Akintoye joining us now. Thank you so much for joining us, Akintoye, and good morning. Well,
good morning. Great to have you.
2021 began on a positive note for the oil market as global oil benchmarks rallied to pre-COVID-19 levels on the back of depleting oil reserves. Oil supply tightening and global economic reopening, all of which could be attributed to the positive developments surrounding the COVID-19 vaccines. Recently, however, the oil market has begun to share the gains as the international benchmark, the Brent crude and WTI, recorded 5.8% and 6% declines to $61 and $57.08 per barrel, respectively. What could be attributed to this sudden redirection of oil prices? And do you think the decline is temporary?
All right, good morning. Thank you for having me. So, can you hear me, please?
Yes, we can hear you. Go ahead, Akintoye.
All right. Yeah, so last week, the Energy Information Administration of the U.S. released the oil inventory data for the country. And what we saw was that there was an increase in the level of oil reserve for the U.S. And as a result of this, investors reacted, the market reacted negatively as we saw sell-off during the beginning of the week. Within Friday last week till Thursday, the oil market lost significantly as a result of the U.S. large inventory. However, judging from yesterday's market performance, we saw that the oil prices have started to rebound again on the back of data which shows that demand in the U.S. has now strengthened, and also in the Eurozone, factories have started to produce more, which implies more consumption for fuel. Also, although just having a fleeting impact on the oil price, we saw that the traffic at the Suez Canal, which is a major canal for bringing oil from the Middle East to the western part of the world, has been blocked due to one huge tank that got stuck and prevented others from moving through the canal. So this has supported marginal increase in the price of oil. However, looking at the oil market generally, we expect that the rollout of vaccine and more reopening of economic activities is basically what's going to support the oil market. And we believe that we are going to have a significant pricing for oil compared to what we had in 2020 when the world was struck with the COVID-19 pandemic.
All right, Akintoye. Well, talking about the pandemic, based on the IMF's projection, the global economy is expected to recover by 5.5% in about 2021. While the rollout of the vaccine has continued to gain momentum across the world, Africa seems to be lagging, accounting for about 1.8% of global vaccination, which stood at 475.6 million as of 23rd of March. The IMF has predicted a 3.2% growth for sub-Saharan Africa, with some major drivers will be rollout of vaccines. You know, with the vaccine rollout still considerably weak in the region, do you anticipate a slower recovery?
All right, so like you rightly pointed out, across the world, we have seen a lot of countries and regions importing vaccines for their citizens. And Europe and Asian region are the ones leading the world currently, while country-wise, the US and Israel are the major countries which are buying in vaccines and ensuring that there's enough vaccination in their countries. However, for Africa, we have seen that the impact of COVID-19 on the fiscal ability of government has reduced the ability of the government to be able to purchase these vaccines for their countries. Also, when you consider the infrastructure that are needed to be able to manage these vaccines, they are not presently in Africa. There's no sufficient infrastructure to manage these vaccines. So as a result of this, we have seen weak importation of vaccine to the region. And what this could imply is that with the new COVID-19 strains, if we see a surge in COVID-19 cases, there could be strict COVID-19 measures which could affect economic activities, thereby impacting negatively on the ability of the region to achieve the 3.2% growth projections by the IMF.
Well, we did see the MPC weighing, whether to keep interest rate environment attractive enough to drive FX inflows or tame inflationary pressure. Well, what's your take on this whole decision of the Apex Bank at this time?
All right, so the decision of the Apex Bank is quite justifiable. Given the fact that in Q4 2020, we only recorded the marginal growth, although it was unexpected. Nigeria grew by 0.11% in the fourth quarter. While we could also argue that the level of inflationary pressure that we are seeing in the country right now could have warranted the Apex Bank to tighten the economy more by raising the MPR. We could also justify the action from the unemployment data, which was released recently. However, what we think is that due to the decision of the Apex Bank or the Monetary Policy Committee to hold the key policy rate, we are likely going to see sustained growth in the domestic market. However, due to inflationary pressure going forward, we might still see the Apex Bank tightening the economy by raising major policy metrics in subsequent quarters to curb the inflationary pressure and also attract foreign investors into the domestic market.
All right, since the beginning of the year, we've had an uptrend in the yield environment. There's also been a short supply of FX across exchange rate windows, even though we've had improvement in oil prices. So, considering the central bank's aim is to, one of its aims is to try and support access to dollar, with the weak participation of foreign investors, at this time, what is your outlook on FX for 2021?
All right, so for the FX market, this will likely be shaped by the recovery of the oil sector. As we see more vaccine rollout and more economic activities, we should see improved demand for oil, and this will definitely bode well for the country as we're able to earn more due to increase in prices and increase in output. So this will provide the central bank more FX to be able to defend the naira at the FX windows. Based on what we have seen so far from the beginning of the year, we have seen weak FX supply at the I&E window, which is a major FS segment for investors and exporters. And this has continued to deter foreign investors from participating effectively in the domestic market. Also, there's a general view that the naira is currently overvalued, and foreign investors are still on the sidelines, waiting whether to see if the central bank is going to devalue the naira again, so as to be able to reduce the FS illiquidity pressures. In addition to all these, the CBN's naira for dollar scheme will likely also support more FX inflows and the ability of the foreign of the CBN to be able to defend the foreign exchange at the I&E window. So these are the factors that will likely shape the FX market in 2021.
Well, coming back home now, the fixed income market has seen an upward trend in yields since the beginning of the year. And of course, this has been a major driver of the financial market performance. How do you expect this to react to the decision of the MPC?
All right, so based on the decision of the MPC that we saw previously in January, we saw that they held the key policy rate constant. However, yields still trended higher due to the fact that at the money market auction for the OMO and T-bills, we saw that the stop rate rose significantly higher. And as a result of that, investors priced this into other securities. However, given the fact that in the last auction that was done at the money market, we saw that rates were relatively stable. So adding this to the fact that the Apex Bank has now maintained policy rates, we might see some stability in the fixed income market. However, this is not to say that we are not going to still see an increase. However, we cannot compare that the volatility with what we had at the beginning of the year.
All right, the equities market has sustained a negative performance for up to 7 weeks. Now, when can we, start to see the equities market start to, get back to its old self again?
All right, so what we have seen in the last 2 weeks was that people are starting to position in the equities market again due to the light sell-off that we have seen for over 7 weeks. Now, last week, the market recorded 3 gains. However, there was a significant decline on the last trading day, which led to the equities market sustaining losses. Judging from this week now, we have also seen buying interest again. In the last 3 trading days, the equities market recorded two bullish performance and only recorded mild bearish performance. So looking at the auction that happened yesterday, we should see a moderate reaction in terms of a bearish sentiment in the equities market, given the fact that the increase in the stop rate is not that significant compared to what we had in the money market at the beginning of the year. So the equities market has started to gain, especially for stocks that are declaring dividend and have recorded strong performance in 2020. So this has started to drive in the positive sentiment for the equities market. And although we could see a little bearish performance in subsequent days, the equities market looks more attractive now. We could also see the bullish sentiment resurfacing maybe at the end of, maybe towards next week, we should see the bullish performance resurfacing in the equities market.
All right, Akintoye Yelako, thank you so much for your time. Investment analyst with Cordros Asset Management Limited. Thank you so much for your time.
Thank you.
All right, commodity market update is next after this moment. Do stay with us.
Welcome back. Well, on commodities market today, our major focus will be on oil and steel, a subsector of the mining and quarry industry, which contracted by 8.54% in the fourth quarter of 2020. But first, let's look at the burning economic issues and their implications with Desola Sumoni, a research analyst with financial derivatives company. Good morning, Desola, and thank you so much for joining us.
Good morning, Nini. Thank you for having me on the show.
Yeah, you're welcome. So take us through the burning economic issues and their implications for the commodities market.
Okay, let's start with the decision by the central bank on Tuesday. So that, I think, the central bank maintained status quo on all monetary policy parameters. So that has a muted effect on the domestic commodities market. And I think also because of the weak transmission mechanism, we don't expect to have any effect on the domestic commodities market. Regarding the second burning issue, which is the oil market, we've seen oil prices, trend higher because of a very interesting scenario where, this large vessel called Evergreen, which is as tall as the Eiffel Tower and weighs more than 200,000 metric tons, was stuck sideways in one of the busiest, what's it called now, maritime trade routes in the world. So that caused like backlog. You can think of it as traffic, on this very busy waterway. Bloomberg estimates that about 186 vessels are stuck in that traffic, and goods worth around $9.6 billion are also stuck in that traffic. What is the effect? Well, currently oil prices are higher, but I think that in the next couple of days, the blockage would be free, the bottleneck would be loosened, and traffic would move. But there's already delays, delivery dates have been missed, and I think overall, the effect of this is currently higher oil prices. But I think after the traffic eases, oil prices would ease as well.
All right, so the commodity in focus is steel, and global steel consumption fell by about 2.5% to 1.84 billion tons in 2020, according to Intelligence Unit. And we noticed that consumption patterns diverge significantly between China, which is the largest steel consumer. What do you think will happen to the global demand and supply for steel in 2021?
I think the outlook is quite positive for demand, because first we are seeing fiscal stimulus from major countries, which is increasing demand for construction and which is increasing demand from the construction and the infrastructure sector. Also, as many countries ease lockdown and with the rollout of the vaccine, we are seeing increase in demand coming from the automotive sector, particularly demand for commercial airlines. Even the World Steel Association estimates that the steel demand for 2021 is steel demand growth for 2021 is estimated to be between 4% to 5%, excluding China. Now, when you exclude China, it rises up to 9%. And this is because last year, while many countries were still battling the effect of coronavirus, China was ahead of the curve, and the government invested heavily in stimulus packages, which increased demand from the construction and infrastructure sector. On the supply side, however, the OECD estimates that supply growth will be between 2% to 3% in 2021. So we are seeing a situation where steel demand outweighs the steel supply for 2021, and we think prices will remain elevated throughout the year.
All right, thank you so much, Simon, for joining us all the way from Reading in UK. We'll now talk more about steel. Like we said, the commodity for today is steel. So joining us to talk more about this as the commodity and the industry is the chairman of Africa Industries Group, Mr. Raj Gupta. Good morning, Mr. Gupta, and thank you so much for joining us. Mr. Gupta, I think you should unmute yourself. We can't hear you.
I have I've unmuted you and I can hear you.
Yeah, we hear you now.
Yeah, we hear you now. You're good now. Good morning and thank you for joining us. Well, the Nigerian iron and steel industry has been moribund for over 4 decades, and it's a perfect example of how not to grow an industry, one would say. Well, recently there's been a lot of sound bites and good rhetoric about reviving the abandoned steel plant. Many analysts conclude that we are skeptical about policy promises without any tangible. As a new investor in this sector in the country, what gives you hope that things will be different this time around?
Well, the reality is that Nigeria is having an acute shortage of foreign exchange, and that has forced us to look inwards within the country to see what we can do to put Nigeria back on its own feet as far as the steel is concerned. Our group makes 1.2 million tons of steel, and we save over $1 billion of foreign exchange for the country. And this is a major step in Nigeria being self-sufficient in terms of steel. And rather, we have started exporting steel for the last few years as well to the neighboring countries.
All right, Mr. Gupta, you recently acquired a Tower Aluminium Company, which is a very bold move on your side. What has been your experience so far?
Well, the metal sector is related to each other, and aluminium and steel go together. So it's within our sector that we, and it's all used in the same construction and building materials industry. So it's an allied, and it's a product the products are such that they give us synergy in our group, and we have the trained manpower and the experience in handling the metals business for over 3 decades in Nigeria. My experience, to answer your question specifically, our experience has been quite pleasant. We bought it during the height of the pandemic, and it was a big risk because the whole country was in lockdown. And since that, we have started the operations, and the company is now back on its own feet, doing well. Thank you.
Okay, Mr. Gupta, but I'd also like to know, who are your leading customers, and how are your activities helping increase output and employment in Nigeria?
Our leading customers are the Dangote Group, with all the steel supplied to their refineries from us, because we are a manufacturer that makes a high quality of steel, which meets international standards. And our steel can be exported all the way to the UK without even having to be tested. Our other esteemed clients are companies like Julius Berger and other international construction companies who require certified steel for high quality steel for their projects.
So the building materials industry is enjoying a mini boom as a result of low interest rates and government stimulus and spending plans. Is increased government investment in infrastructure and policies having any direct or indirect impacts on your company? And do you feel optimistic about the Nigerian economy in this year and next?
Government sector definitely has an effect on the demand. In our sector, it's mainly it's indirect demand. We don't really have dealings with government directly as far as the sales of our products are concerned. But they drive the economy. They're the biggest driver of the economy, and they are concentrating on giving out jobs for the infrastructure development of the country. And without steel, there is no infrastructure development. So definitely it helps us. However, I feel that the true potential of Nigeria is much, much bigger than what is the current state of affairs.
All right, so this subsector contracted by 18.44% in the fourth quarter of 2020. What would be your recommendations to boost the industry output?
My recommendation would be the government should engage more with the leading players in the sector and understand our problems. And it's a two-way street where we can explain to them what we need and what their expectations are, so that we can have a fruitful dialogue and move forward in discussions.
So given these suggestions you're making, the collaboration and talking to the government, what is your medium and long-term outlook for the industry in the country?
For this industry, I think the outlook is very, very positive. We have, for the last 3 years, been involved in a project in Kaduna State where we are doing a backward integration of making steel from iron ore. And this is in line with government policy they have with Ajekuta, where we need to be self-reliant on steel production. And in fact, we'll be the giant in Africa, providing steel for all over the continent as a result of what we are doing.
We certainly look forward to that, Mr. Gupta. Thank you so much for sharing your thoughts with us, and we wish you a successful collaboration and investments in the country. Mr. Raj Gupta is a chairman of Africa Industries Group, and he told us a bit about the industry. Well, we'll take a time out and we'll be back and go to Eddie for the markets. Well, talking about Dangote yesterday, we did see the 16 Naira proposed dividend, and we expect that the market reacted to it yesterday. Eddie, what was the reaction?
Good morning, Ini. You're right. I mean, investors were smiling in the market yesterday as the all-share index was up 0.98%. So we had a bunch of earnings coming to the market. Of course, investors reacted to Dangote earnings. We saw earnings from Lafarge. We saw earnings from Stanbic IBTC. And they're all positive. So hopefully today we'll see more of those positive sentiments, because investors will still be reacting to that this morning. But the all-share index was up 0.98%. At 39,085.78 points. Now we've gotten back to the 39,000 psychological level with the equity cap at 20.449 trillion naira. However, volume, value, and deals traded yesterday were lower compared to the previous trading session, as we saw volume decline by about 4.6% to 361.90 million units, worth 5.70 billion naira, which was also lower by about 24%. And all of that was traded in 4,018 deals. Now, GT Bank, UBN, Union Bank, and FBN Holdings were the most traded stocks by volume, while we saw same GT Bank, Zenith, and Union Bank top the value chart. Sectoral performance was mostly positive yesterday. The banking sector was up 0.21%, was down 0.21%. Now we saw some declines from some of the tier 1 lenders. However, today we're expecting to see some positive movement in that space as investors react to the earnings of Stanbic IBTC. Consumer goods was up 0.73%. We saw lots of positive sentiment on that stock. Industrial goods was up 0.65%. So that was due to the positive sentiment we saw from Dangote and Lafarge Wapco. I'm sure today we'll see more of that because Lafarge earnings were also quite impressive. Insurance sector was down 0.56%. While the oil and gas counter was up 0.68%. At the unlisted securities market now, the NSI was up 0.65% at 726.14 points, while the market cap was at 516.15 billion naira. We saw 344,400 units worth 18.08 million naira traded in 8 deals. Now, the bond market, there was a bond auction yesterday, which was oversubscribed by over 100 billion naira. We saw a lot of... The market was, although we saw investors, pay attention to that market, we saw the yield in the space rise by about 20 basis points. We saw a lot of demand, especially for the April 2049 and 2045 bond. There were 35 deals in that space worth 36.61 billion naira. Now, there was a bond auction yesterday where the DMO sold about 262 billion naira worth of bonds against the planned 150. So initially, the plan was to sell 150 billion naira worth of bonds on the 3 auctions, so 50 billion naira for each of the maturities. But we have Caleb Alimi, a fixed income dealer at FSDH Merchant Bank, to talk more about the bond auction. Good morning, Caleb. Thank you for joining us on the program.
Good morning. Thank you for having me.
So there was a bond auction yesterday, and we know it was oversubscribed. Could you just tell us more about the turnout and what the rates are now?
Okay, thank you for that. The bond auction, there was a bond auction for 3 maturities, like you rightly mentioned earlier, for March 2027, March 2035, and July 2045. 50 billion each on offer. We saw the auction was largely oversubscribed, and then the DMO also, kind of like met most of the demand, selling about an average of 80% of the demand that came to the auction, with the largest sale happening for the 2035 paper, where the demand was about 158 billion, and we ended up selling about 131 billion of that paper. We also saw yields pick up across the curve, across the 3 maturities from where they were at the last auction. The last auction for the 2027, 2035, and 2045 papers closed at 10.25, 11.25, and 11.80. We saw a 25 basis point uptick in the 2027 and 2035 paper, and a 20 basis point tick in the 2045 paper. That one closed at 12%. The reaction in the market has been a little muted due to the fact that most of the demand was largely met. It was very well met, like I said, over 80% was sold compared to what was sold last month. Last month, the DMO raised just a paltry 80 billion from the market, and then this auction, they raised over 260 billion from the market. So the The reaction of the market is a little muted, like I said. There's very little demand, as most of the demand has been met at that auction. We expect that rates are going to stay stable for now on the back of, very little demand, and then we expect it to track downwards subsequently after.
So what impact?
The bond auction. Yeah.
Okay, but what impact will this auction have at the Treasury bills market, investors at the Treasury bills market, for example?
So what we've seen at the Treasury bills market is we've seen the one-year paper continually tick upwards. So investors are actually going to demand for better rates also for the one-year paper that we expect to see. So yes, they're not taking the Treasury bill space.
Well, I mean, yesterday was the first trading day after the MPC meeting. I mean, was that decision in line with your expectations? And how did the markets actually react to that? I know yesterday they had to chew on the MPC and the bond auction, but from the MPC side, how did investors react to that?
Investors' reaction to the MPC was, it was unconnected, so to say. Investors expect that the government has to borrow. This year, they have a 4.4 trillion budget deficit, and they have to borrow to fund that budget. So investors will continue to demand a higher rate. The market yesterday did not react aggressively to the MPC reaction of holding rates steady. But we found that investors need to look for better yield in the market. So the Treasury bill demand is asking for slightly better yield. We're seeing the same for the bonds. We're expecting to continue that with due to the size of the budget deficit.
All right, Caleb, thank you for your input on the program. Enjoy the rest of your day. Caleb Alimi is a fixed income dealer at FSDH Merchant Bank. Yesterday, the Treasury bills market was mute. We didn't see any activity at the Nigerian Treasury bills market. Same with the CBN special bills market, while yields fell by about 4 basis points at the OMO markets. But with rates at the bond market, I mean, yesterday the auction for the 10-year, 15-year, and 25-year bonds were at 10.50%, 11.50%, and 12% respectively. Now, these are high rates at the bond market, and I'm sure investors are really happy about that. So, unfortunately for the equities market, this is going to tilt attention towards the fixed income market even more. So we just keep hoping for more of those positive earnings. I'm sure today's trading will also be positive because of the earnings that came in yesterday as well. But then in the long term, if the yields in the fixed income space continue to rise this way, unfortunately, I'm not sure what's going to happen at the equities market, Ini.
Honestly, Eddie, I mean, I was hoping that with the earnings released yesterday, at least, well, fine, the market ended in the green zone yesterday, but I mean, the deal, the volume, everything was in red, and now we have the bond that was up yesterday with so attractive interest rate, and I don't know. I really don't know.
We'll keep our fingers crossed, and we'll just keep hoping for more positive development in the market.
It's been crossed for so long. Anyway, we'll take a break now. When we come back, we'll go to London. And now we get updates from London with Juliana. Good morning, Juliana. Well, John Lewis has confirmed plans to permanently close 8 more outlets, including the department stores in New York. And this could lead to the loss of about 1,500 jobs. What implications do you see in this move? Especially unemployment data was released and we saw good news that it was a little bit lower. What would this do to that?
Well, yes, as you said, earlier this week we had unemployment data showing that Britain's labour market was finally showing some sign of recovery. I think the worst case scenario is all but over. But of course, for the high street, it's anything but that. I think city councillors overnight, they've been describing this move by John Lewis as a hammer blow to town centres and city centres that have already been reeling from the loss of hundreds of thousands of jobs. We've had some massive stalwarts over the past couple of months closed down, including Debenhams and the Arcadia Empire. And John Lewis is just another one of them. This is part of sweeping reforms that John Lewis have started last year. 1,300 jobs went when 8 stores were closed at that period. Then 1,500 jobs were lost in head offices. And then, of course, at the beginning of the year, for the first time in over 100 years, they reported losses of £530 million. Dame Sharon White, the chief executive officer, she is basically saying that John Lewis has to change. I think all high street stores are going through this sudden change at the moment, and that's because consumer habits have changed, and they've changed forever. So to survive, some of these brutal cost-cutting measures are going to be ongoing.
Well, they say change is the only constant thing in life. Well, a new £50 note featuring the scientist best known for his code-breaking work during the Second World War has been unveiled by the Bank of England and will go into circulation on the 23rd of June, which is the date of his birth. What more do we know about this?
Well, yes, the process has been ongoing for a couple of years when the Bank of England announced that they were looking for a hero to appear on its £50 note. There were tens of thousands of entries. Alan Turing beat off a pretty tough cast. He was a pretty highly acclaimed British mathematician. Some people deem him to be the father of modern computer science, and he's actually known for helping Britain win World War II by cracking some pretty difficult codes. I believe one of those codes are going to be placed on this new £50 note. As you said, it will be in distribution on the 23rd of June, which is Alan Turing's date of birth. It's going to be much more difficult to counterfeit. We know there are millions of pounds worth of counterfeit notes across Britain. This is going to be a plastic note, not a paper note. It's a polymer note, so very difficult to rip as well. But yes, it's celebrated good news. It was unveiled earlier today. It's a shame I can't show you it. I don't actually have one. But as soon as I do, I'll make sure you and the viewers get to see it.
Oh, we'll be looking forward to that. Well, retail giants Nike and H&M are facing a backlash in London and China, beg your pardon, after they expressed concern about the alleged use of forced labor in the production of cotton. What is the discussion around this where you are?
Yeah, this is an interesting story. It's having economic implications, but it started off as a geopolitical story. I'm sure many people are aware of the Uyghur community in northwestern China. It's a predominantly Muslim minority community that have been detained in camps. A couple of days ago, governments across the world, including Britain and America, decided to impose sanctions on officials within that region, freezing their assets and restricting their travel outside of the region. And some comments that H&M and Nike made about the Uyghur community have been unsurfaced. These are not recent comments, according to sources. They were made quite a while ago, and now celebrities in China have decided to stand up against H&M. They believe that trying to ask people to boycott cotton from Uyghur is just completely unethical, considering H&M and Nike make so much money. So yes, they've stood up against them. And in fact, I think some local media channels in China are also on the campaign against H&M and Nike. H&M have released a statement saying that, you know, they don't get involved in politics, that they adore the Chinese consumer. But again, this is much wider a story about the Uyghur community and what some governments have called a vast implication of human rights.
Wow, that's a very interesting story that I know will go really, really wide. Well, thank you so much, Juliana, for bringing us updates from London, and enjoy the rest of your day. Well, now we'll find out what's going on in the crypto market with Laddie Williams, and I hear it's a sea of red. Oh, yep, the sea of red. You know, I told you yesterday that once Bitcoin makes a big move up or down, the altcoins actually do suffer. As you see here, the market cap, $1.65 trillion, down about 3.80%. 24-hour volume, $161.70 billion, up 34%. You know, with the sell-offs happening and all, this the volume actually went up. Bitcoin dominance, 59.98%. Still good for altcoins, you know, if Bitcoin can actually stay stable for now and not give this big swings. At 8 a.m., $53,000, down 2%. Now it's trading about $52,000
You know, I told you this market, very volatile, so you can't predict where it's going to go. 24-hour volume, $79 billion this morning. Price of Ethereum, $1,600, down 4.59%, $38.726 billion traded. Top alt by market cap, BNB down 3%, $247. Even though it's had an amazing run, year-to-date performance, about 567% up. In January, it was trading for about $40 per coin. ADA, Cardano, up about 0.07%, $1.11. DOT, Polkadot, down 9.66%, $30. XRP, down about 8% this morning. Let's talk to Olumide Adesina, now financial market analyst. Hello, Olumide. Great to have you.
Yeah, hello, good morning, Ladi. Thanks for having me.
Good morning. Good morning. So it's a sea of red. You know, Bitcoin went as low as $52,000 this morning, even though there's been a bullish news with Fidelity launching the ETF. Tell us about this.
Yeah, actually what's happening in the crypto market is there's been a dark cloud in the past few days. Don't forget that the most powerful monetary policy maker, I'm talking of Powell, that oversees the $20 trillion monetary policy market, and that's the United States, really gave a negative bias on Bitcoin, saying that these assets are not suitable for wealth preservation. And we saw a downward push towards the price. In fact, we saw the prices losing as much as $4,000 or $5,000 in a couple of hours after such fundamentals were released. And that really kept the selling pressure on. And in spite of the fact that Tesla announced that they were going to start accepting Bitcoin for a form of payment, we saw some pullback in the losses, but the selling pressure kept on. That's to tell you that institutional investors are now weighing on regulation as a growing risk. And just recently, Amundi, one of the leading asset manager in Europe, also spoke about the fact that crypto regulation is going to have a negative impact on the market. Don't forget that the reason why the crypto market is thriving is the fact that it's decentralized in operation. It's kind of destructive. It's different from the traditional ways of finance. So we are seeing selling pressure on that. But, you know, Fidelity Investments, one of the leading asset management with assets of over $5 trillion, recently spoke about using ETFs. So you have expected that would be a bullish bias. But one of the reasons why institutional investors are not yet so convinced is that those ETFs are designed for investors that indirectly want to get exposed to Bitcoin, but they still need SEC approval. And over the years, SEC has refused to approve the United States exchange-traded funds. So that is really the narrative that is happening in the crypto market. The dark cloud is just over. So we are seeing sell-offs across market spectrum presently.
All right, Lumide, major sell-offs. What altcoin are you bullish on?
Basically, the two altcoins that I'm really looking at Twitter for the fact that it has a lot of intellectual capabilities. I'm talking of the fact of in the area of cloud, and you could see areas like Google partnering with that coin. So I think I've seen it rallying. Then another one is Chili's. Chili's, of course, is my favorite because of the fact that it has an underlying strong fundamental support. In the past 3 months, it has rallied about 1,000%. And that's the fact that because you see a lot of institutional brands coming to it. I spoke earlier, Man City and stuff like that. And just recently, they're going to the United States. So it looks like a bullish run.
All right, Olumide. Thank you so much. So it's T4 Chili's for you. Thank you so much, Olumide. Do enjoy the rest of your day. So, Ini, there you have it. T4 down 23%. Data down 16%. These two have had an incredible run, but profit.
But Bitcoin is still the king, man.
Exactly.
Especially with Tesla's move, you know.
Yes, Tesla now accepting Bitcoin for their cars. That's actually really bullish news. As you know, Elon Musk is a big fan of Bitcoin.
All right. Thank you so much for joining us on the show today. It's been really wonderful. I'm Ini John Mekwa.
And I'm Ladi Williams. Thank you for watching.